And so we'll let Peter and Rebecca take it away.
Thank you so much. So my name is Rebecca Sheppard. I'm here with Peter Haukebo, and we are tax attorneys. So I know you are all thinking we are the coolest kids in the room, and you would be right. Before the pandemic, Peter and I mostly did, God, I do like the reactions. I don't get this often. This is going to be very exciting for me. Before the pandemic, Peter and I mostly practiced in tax controversy. And what that means is we worked with organizations and businesses on defense, right? IRS audits, payroll tax liabilities, sales tax liabilities, and all those kinds of things. When the pandemic hit, we knew we needed to dig deep and figure out how best to help our folks stay alive, stay operating for when they were going to be closed. So what we did is we dug down deep into the CARES Act and worked through PPP. And then after that, we worked through EIDL and RRF and all of these different programs, and eventually led us to the Employee Retention Credit. And originally, you couldn't use PPP and ERC together, and so we didn't pay a whole lot of attention to it at first. But in December of 2020, Congress decided that you could use these two programs together, which kind of changed our practice. We started getting the Employee Retention Credit for our clients that qualified, and it meant that all of their tax liabilities were getting paid in full, and they were even getting money on top of the liabilities. They're getting money back from the government. It was a game changer for all of our clients. And since then, we've been kind of on this educational tour, working with organizations such as this one to help with all kinds of different credits. Now, we will talk about the Employee Retention Credit because it's the most lucrative tax credit out there, like in my lifetime out there. But we'll talk about other things as well in hopes that we can help you build a better business. So with that, I'm going to kick it on over to Peter.
All right. So yeah, and sorry, I lost my voice. We're not going to spend this whole time on the Employee Retention Credit, but it is the biggest thing that's out there. And also there's a lot of junk out there. So, I imagine your industry is one that you've certainly heard of this. That you're probably getting hammered from many different directions and advertisements and text and phone calls and all this kind of stuff. We just want to run through briefly the eligibility analysis because that is what is being glossed over with some of these ERC mills and these companies that are sort of popping up out of nowhere to do this stuff. And the government was silent about it for a fairly long time after the legislation and the guidance came out. And it wasn't really until October of last year where they warned and said some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit, and reminding taxpayers that they could have to repay the credit along with penalties and interest. So I just want to sort of position this conversation of, a lot of this is about tax planning, business planning, some thoughtful things that you can do for your businesses and your centers. One of the things that you can also do is, if you've already claimed ERC, make sure that you've done it correctly and be thoughtful if there are issues. If something triggers you and you say, oh, I'm not sure if my person did that, or maybe now you're going to think twice and say, I'm going to go back and talk to them again. That's the point of this conversation. Losing my touch.
You are losing your touch. I feel like we missed a slide. What is the Employee Retention Credit? First, to qualify to be an eligible employer, you need to be operating a trade or business during a calendar quarter. And there are two ways to qualify. I did it all without the slides, so you're very impressed.
Interesting.
One is a significant decline in gross receipts. So for 2020 compared to 2019, it's a 50% decline. That's a tough margin to get to. I know some of you folks had to completely close, and so it's possible that you'd be eligible based on gross receipts. when Congress decided you could use ERC and PPP together, and that the government, the business wasn't going to come booming back after 8 weeks, it changed the way the credit worked. It made it easier to get and more lucrative. So for 2021, all you need is a 20% decline in gross receipts compared to 2019. There are alternative reference periods for 2021 quarters that allow for automatic qualification for successive quarters. What that means is if you have a 21% drop in Q1 of 21, to get qualification for Q2 of 21, it doesn't matter what your receipts are. We've had people whose receipts have gone up 2,000% the next quarter. You are still automatically eligible based on the way the rule works. It makes some people uncomfortable, and that's their choice of how they want to claim the credit or not. But it's an automatic qualification. So if you fit the parameters of the program, then you're going to be eligible. This is a pretty black and white test, and it's not something that you necessarily need a lawyer to look at. But the next test is more complicated, and this is kind of where Peter and I spend, I say 80% of my day, but I think that's just because I'm in denial. It's probably closer to 90. And we have discussions and arguments and go back and forth about what is considered a full or partial suspension of trade or business operations. So the other way to qualify is the operation of a trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority, that's federal, state, and local, limiting commerce or group meetings due to the coronavirus disease 2019. So one, you need a governmental order, needs to be a United States, state, or local order. People will ask us about orders from China and things like that. It does not work. And it needs to be an order that is because of COVID-19. So if there was something that was in place prior to COVID-19, that isn't going to be sufficient. That's not going to rise to the level of a government restriction here. So the way you're looking at it is if your business is fully or partially suspended, so meaning that a swath of your business you just couldn't perform. So I take the example of a restaurant because it's a really simple example and everyone can kind of look at it and understand it. But we'll get into childcare operators and things like that in a little bit. But for a restaurant, indoor dining was completely suspended in 2020. You could not eat in a dining room, basically anywhere in the United States. As a portion of a restaurant's business, they were still allowed to do carry out, delivery, curbside, things like that. But the in-person dining was suspended. If in-person dining was more than a nominal portion of the revenue generated in 2019, then that restaurant is going to qualify for the employee retention credit as long as that business portion is fully suspended. Now, at some point, usually somewhere around the summer of 2020, indoor dining was back open, but it had modifications. So you had to have a capacity limit or 6-foot social distancing or curfews imposed, additional sanitization procedures. Now you're looking at whether or not those modifications had more than a nominal effect on the business's ability to provide goods and services. And that's a lot more complicated because you're looking at whether or not, including DoorDash, including carryout, including delivery and drive-through and all those other things, whether or not those restrictions, that capacity limitation still had more than a nominal effect on the organization's ability to provide goods and services. What that means is that if anyone ever tells you you're automatically eligible or you certainly are eligible for XYZ, know that that's almost impossible for them to know unless they've dug into your facts and circumstances and asked these questions. Do you want to go to the next slide? So just real quick before we get into the next item. So for childcare operators and nursery schools and things like that, the modifications that were required for children. And so Peter has 3 kids, I have 2. All of our kids are under 10. So we had babies and up during the pandemic. So we totally understand how challenging this was for you all. Keeping a 2-year-old 6-foot socially distanced sounds really, really hard. But those are things that you all had to deal with. Having groups changed, right? So normally you had 20 kids in a classroom and 2 teachers, and you could move those kids around. You could do what you wanted throughout the day. A lot of these restrictions said, okay, instead of 20 kids, you need to have that to be 10. Groups of 10 or more only. You need to make sure these kids are socially distancing. You need to up your sanitization. You need to not allow parents into the schools, and you have to work in cohorts. If kids are out for 3 days, those kids you can't move things around the way you normally would have in a flexible environment. And the question is whether or not all of those restrictions, you all know them, had more than a nominal effect on your ability to provide goods and services. Just checking to see.
And just briefly, I mean, look, audits are starting to happen. The government's coming back behind and they're saying, quantify this stuff. And that's where this stuff gets really hard. And where we work with clients to make sure that they understand, look, this is what I would be, presenting to an auditor who was trying to look at a case like this. So there is a third method of eligibility called a recovery startup business. So we won't spend a lot of time on this, but it's very definitional in nature. So by definition, the business began operations after February 15th, 2020. On average, the gross receipts of the business were less than $1 million. Controlled groups, and we'll talk about that on a subsequent slide, matter here. So if you own multiple businesses or individuals who own a business with you own multiple businesses may have a control group. This credit is for Q3 and Q4, and it's the only way to qualify in Q4 of 2021. The catch is that it's $50,000 per quarter, so a total of $100,000 if you're a recovery startup business and not otherwise qualifying under method 1 or method 2. So just quickly, this is like a 4-hour course, stuff that's just on this page. Basically, the ERC was built on top of existing tax law. Controlled groups and affiliated service groups are important to know. So you need to know how the business is owned, what the relationship is between similarly owned businesses, whether it's a parent subsidiary situation, brother sister control group. You can have combined groups, affiliated service groups, and management groups. It just changes the way that you have to think about eligibility here. Additionally, you need to make sure that you're backing out any majority owner wages. So not 50-50, but 50% plus 1. There's also an idea of a deemed owner. So again, those are close family relationships where their wages wouldn't be considered qualified, but it goes pretty far out. It goes down, relationships created by marriage to both step and in-law situations. So you've got to know who's working in the business and what their relationship is to the owners. If you acquired a business during the pandemic, there's a safe harbor to help you think about gross receipts. You need to make sure you're paying attention to that. And then just so you're aware, there's a couple of important dates. First is the refund statute expiration date. So that's the due date. So if you haven't claimed, you still have a little bit more time. Credits related to calendar quarters in 2020 are due by April 15th, 2024. Credits related to calendar quarters in 2021 are due a year later, April 15th, 2025. The assessment statute expiration date, just so you're aware, this is how long the government has to audit for quarters 2, 3, 4 of 20 and 1 and 2. The rule is 3 years from the date of originally filing. So assuming a timely filing, the calendar quarters in 2020 need to be audited by April 15th, 2024. And then for Q1 and Q2 of 2021, they need to be audited by April 15th, 2025. Quarter 3 and quarter 4, Congress gave IRS an extra 2 years. Those need to be audited and assessed by April 15th, 2025. Again, that's assuming timely filing. And then just so you're aware and make sure you're doing this stuff, code section 280 cap C basically says if you get a credit based on wages paid, you lose the deduction for those wages up to the amount of the credit. So what that practically means is that because this code section requires a specific tracing to the wages that generated the credit, you need to go back and amend your 2020 and or 2021 returns and pay income tax on ERC. Do you have anything more to add before we go on to the next stuff, Rebecca?
I would just throw it out and see if anyone has any questions right now, because this kind of ends our portion on the employee retention credit. Like Peter said, we know there's a million companies doing this kind of stuff. I talked to somebody the other day who said they got 4 text messages just that day about it. So we know that that's happening. We don't necessarily think that's the most scrupulous way of running a business or proving qualifications.
Well,
So
if you take one thing away from this, is that the government made this, really easy to do the wrong way and really hard to do the right way. And if somebody qualified you based on, a couple of quick questions that you clicked through on a website, be a little bit concerned. Go back behind and say, tell me why I'm eligible. Show me the governmental orders if you're qualifying that way. Push them a little bit, because I think you're entitled to that information.
for sure.
Were there questions in the chat?
There was one, but we can keep going and I can just go back to it. The next, you're missing your little front page slide.
No, you were just weren't paying attention. All right, so work opportunity tax credit, oftentimes referred to as WOTC, is another one of these tax credits. It's not as lucrative as ERC, but it's still worth taking a look at if you're hiring folks that are in these particular targeted groups. So work opportunity tax credit, or WOTC, is a federal tax credit available to employers for hiring and employing individuals from certain targeted groups who have faced significant barriers to employment. This was supposed to expire at the end of 2020. It was extended in the same legislation that changed how everybody thinks about ERC in the Relief Act in December of 20, and it extended into December 31st, 2025. Generally, it is worth between $2,400 and $9,600 per employee. So the general rule is it's 40% of qualified wages. In most circumstances, the wages are capped at $6,000 for qualified wages. So 40% of $6,000 is $2,400. In the case of certain targeted groups, that qualified wage base goes up to $24,000, and that's how you get to a $9,600 per employee. That's a qualified veteran with a service-connected disability and at least 6 months of unemployment within the 1 year preceding the hiring date. So these are very fact-intensive, but again, worth it. It is a dollar for dollar offset of federal income tax. We will share these slides, and the group can coordinate that. So I'm not going to go through all the details of these, but generally the categories, these targeted groups are qualified 4A recipient, qualified veteran, qualified ex-felon, designated community resident, vocational rehabilitation referral, qualified summer youth employee, qualified SNAP benefit recipient, qualified SSI recipient, long-term family assistance recipient, qualified long-term unemployment recipient. So that's generally the group, the targeted groups. So what are the mechanics for how you actually go about doing this? They're going to make you work for this way more than the employee retention credit, which is crazy, right? But an employer must pre-screen and obtain certification from the appropriate designated local agency. It's also called a state workforce agency. Every state has, every state has its own state workforce agency. In Maryland, where we're at, it's the Department of Labor. It's a quick Google search away, but if you have trouble, let us know and we can point you in the right direction. So on or before the day that the job offer is made, pre-screening notice must be completed by the job applicant and the employer. That is a form 8850. Again, excuse me. A quick Google search away. There's 4 dates. I woke up with the crud. 4 dates that must be on that form 8850. The date the applicant gave the job, was offered the job, was hired, and started the job. The key here is that you have to turn this into that SWA within 28 days from the individual beginning work. Mechanically, how do you claim it? It is a form 8884. That form rolls up into the form 3800, and then it is filed with whatever business income tax return you otherwise will be filing. WOTC is not refundable, so it's not like the employee retention credit, but you can carry it, any unused portion, back 1 year and then forward 20 years. So there's a pretty decent chance that you're going to have an opportunity to use it. Excuse me while I mute myself.
I think it's good that Peter's working from home today. He's keeping his whatever to himself. All right, section 179 and bonus depreciation. This is for helps businesses about how to write things off, when to write things off. Doesn't matter how you do it when you buy something. Oh man. And just something to be thoughtful about. This isn't like hire me to help you with your business bonus depreciation or anything like that. Something to talk to your tax professional about. And again, just kind of like keep in the back of your mind, like you want to buy a playground, when should you do it? You want to, something big, obviously. You need items for your daycare center. This is something to think about. So depreciation of expenses may be taken the ordinary course to write down the asset over its useful life. Bonus depreciation is a tax incentive that allows a business to immediately deduct a larger percentage of the purchase price of an eligible asset. So bonus depreciation is only applicable to certain business assets, including only property with a useful life of 20 years or less. This is what I'm talking about when I say we are the coolest kids in the room, because obviously this is what people want to talk about at a cocktail party. So additional rules also apply. The asset was not used by the taxpayer prior to acquisition. The asset was not acquired by a related party. So you can't like buy a car for yourself and give it to your son and then, 6 months later be like, you know what, I'm going to use this for my business and then depreciate it. So be thoughtful on how you purchase something and how you want to include it in your business. So the Tax Cuts and Jobs Act, which most people know of as like the Trump tax cuts, implemented bonus depreciation schedule. Assets acquired after September 27, 2017 and before January 1, 2024 are entitled to 80%, I believe. 80% bonus depreciation. After 2023, it's going to keep going down 20% per year until it's all the way phased out. Usually Congress doesn't let that happen. They'll eventually include a new way of doing this. But just something to kind of be thoughtful about. Regular depreciation still available after that phase out, which again, I don't think will actually happen. So section 179 is a different type of expense, a different type of acceleration to take an expense, on your tax return. So section 179 allows for an immediate expense deduction for purchases, but limits it to items such as cars, office equipment, business machinery, and computers. The maximum amount that may be deducted in 2022 is 1.16 million. I think that's a typo and it's 2023. State limits may be smaller than IRS limitations. And this is kind of when you want to look at the difference between a 179 expense versus bonus depreciation. Your CPA or tax professional will be able to kind of guide you there. So the items purchased under this rule must be used for business purposes more than 50% of the time to qualify. So bonus depreciation versus section 179. Section 179 expenses can be more flexible with timing than bonus depreciation because the taxpayer can elect to save certain assets for future tax breaks or claim only a portion now. So if you know this is a good year, then buy the playground equipment in December, right? Or by December. If you know that next year is going to be better than this year because you're building a new location or whatever the reason, then it might be better to buy it in January of next year. And that's kind of like what you're looking at as far as like timing of different expenses and which method to use. That's what you want to make sure that you're just being thoughtful. So bonus depreciation may apply to larger amounts. For you guys, unless you're buying really nice playgrounds, you're probably okay with the limits on the 1.16. But I don't know, who knows? Maybe you have something that's very, very expensive.
To the extent you guys were with us for the first two topics, and now this just made your eyes glaze over and you're like, what the heck are these folks talking about? What we're ultimately talking about is being thoughtful and having some control over when you are recognizing income by playing around with expenses, and when to recognize those, and does it make more sense to defer tax until a later point? Typically, yes, but not always. So, Rebecca's saying try to understand how this year is going to change versus next year, and then being thoughtful. And these are just two mechanisms to be able to have some control over recognizing income through expenses.
All right. I'll go through this rather quickly. I don't know if you folks are doing other items on the side, or also like it's possible the research and development tax credit could apply to you. It's something that people don't necessarily think about if they're not in an engineering firm, but it applies to a lot of different types of businesses. We know restaurants, bakeries, breweries, even a law firm that created new client software to interact with their clients and how to capture billable time was able to apply for the research and development tax credit. So if you've developed an app to interact with parents or to capture, I know there's a lot of them out there, like sending pictures to classrooms and keeping like kind of like a bubble around those groups rather than having it on Facebook or via email, then that could qualify. But the research and development credit is a federal credit available to organizations that invest in qualified research and development activities. The credit provides dollar-for-dollar cash savings for performing activities related to the development, design, or improvement of products, processes, formulas, or software. It's a 4-pronged test to determine if your business qualifies. One, if the permitted purpose test. So an activity intended to develop new or improve business component to improve function, performance, quality, or reliability. It can be a product, process, technique, formula, or software. Elimination of uncertainty is prong 2. So an activity intended to eliminate technical uncertainty concerning capability, optimal methodology, appropriate design, process or product improvement. So the process of experimentation. So you need to try a lot of different methods to see which way is the best. So implementation of a systematic approach to identify and evaluate different alternatives to achieve a desired result by trying different technologies, several iterations, modeling, and simulation. And finally, it has to be technological in nature. So it has to use the application of hard sciences. So engineering, physics, chemistry, or computer science. Again, if you have developed some way of interacting with your students, interacting with your staff, if you've created some sort of intellectual property or software, this would be something to think about. And it's another tax credit, right? So what Peter's talking about, when we're talking about planning, part of this is like saving money, and part of it is trying to get every dollar available in credits that are possible.
My turn.
Your turn.
All right.
How you doing?
Let's see if I can get through this. Choice of entity is important because it affects the way that you are taxed. There are tax reasons that I'll go through to choose one entity versus the other. There are certainly non-tax business planning, other ideas of reasons why you would choose one entity or another. The simplest is the sole proprietorship. That is, you're just hanging out a shingle, and there's no entity around you. That is one that's not a good idea. So if any of you are true sole proprietors and don't at least have a single member LLC, for limited liability purposes, you really ought to have some sort of entity in place. The next simplest then is a single member LLC, which for tax purposes is disregarded by the government. They pretend it doesn't exist. So this is a pretty tax inefficient structure because you're paying both income tax and self-employment tax, which adds up quickly. Your income tax is going to be at whatever, blended rate you overall, otherwise have, but, self-employment tax, 15.2%. Partnership and multi-member LLCs is, the next one. The key thing to understand here is the relationship between the partners and the partnership itself. In this situation, the partner is paying, similar to the single member LLC, both income tax and self-employment tax, because each partner is considered to be self-employed with that partnership. So also very tax inefficient, but because of some of the requirements of corporations, it may be desirable for business purposes. If you have one partner that is going to receive, accelerated distributions, or there's some sort of reason you're treating partners different, you can't do that in an S corp, for example. With corporations, C corporations and S corporations, the tax rate has come down on C corporations from the Trump era tax cuts, TCJA, that have made it a little bit more attractive. And there's some stuff you can do with Section 1202 with non-recognition of income, capital gains from the sale of C corps in certain very, limited circumstances. So you could possibly choose to want to do that, but they're generally still tax inefficient because there's a double layer of tax. So the C corp itself is considered its own taxpayer. It's going to pay tax on income it generates, and then the shareholder, when a distribution or a dividend is paid, is also going to pick up tax on their individual income. And, that's really the same dollar being taxed twice. S corporations, even after TCJA, remain the most tax efficient. There are some, business reasons you might want to do it. And again, that's because you have to treat all of the stockholders the same. But the difference here is the relationship between the owner and the company, because now instead of being a partner, they're an employee. So you've got to do a little bit more work. You've got to pay yourself a reasonable salary, but the income that otherwise passes to the owner is not being subject to self-employment tax, and it's only being subject to income tax. The reasonable salary catch is a big deal though, because you're going to be motivated to pay yourself a small salary, because then you don't have to pay FICA taxes on it, and it just passes to the taxpayer or to the owner as income subject to income tax. So what is reasonable salary? Well, it's not $5,000 a year, that's for sure. But it is basically the idea that what would you pay a similarly situated taxpayer in a similar location doing similar work. There are certainly resources out there to help you research it, but it is not a hard and fast and easy thing to come up with. So again, just be thoughtful in the entities that you choose because they have tax implications.
So the other kind of part of the TCJA, and depending on where you live, it may be a bigger deal than otherwise, but in certain states, some would say blue states, income taxes are higher, property taxes are higher, and the limit on itemized deductions of $10,000 for income tax and property tax is more substantial to those folks. So those types of states, Peter and I practice in Maryland. Maryland's governor, Larry Hogan, was very concerned about this because he was worried that people were going to start to flee the state because they're going to be paying a lot more tax than they used to be. So what he put together, his people and other blue states figured out a way to kind of pass the tax burden on for business owners onto the business. So it doesn't help W-2 employees, but it does help business owners such as yourselves. So what this means is that in some states, what you can do is pay your local tax, your state and local tax through your company. If you have a pass-through entity, so if you have a partnership, S Corp, you're able to pay your state tax through the company, and it'll reduce your income automatically, right? Because it's an expense of the company. And so your K-1 will be reduced. So if normally you would have had $100,000 K-1, you're paying tax through the entity, say it's 10%, just because math is not my strong suit. $10,000 is what you've paid through the entity for tax. Your income is down $90,000. Your K-1 is going to show $90,000. It's an instant benefit. If you are in one of these states and you have a pass-through entity, it is a no-brainer to file this way. There's going to be certain instances where it doesn't make sense. If you make $18,000 a year, it's probably a lot of hassle to not have to do this. But for anyone else, it's certainly something that you should be talking to your tax advisor about. Ask if you can make these elections to pay your tax on the entity level, and then figure out what requirements you need to do. Every state is going to be different. In Maryland, you have to elect by a certain date, file by a certain date, and then start making estimated tax payments on behalf of the company. New York is similar. They have a special form that you have to use, special elections. In the beginning, I remember the law went into effect, was it like December 15th or something in 2021. And so we were calling everyone to hurry up and make an estimated tax payment on behalf of the company by December 31st. Like, you've got 2 weeks, like, just make the payment, like, do what you need to do, like, get this going. Maybe it was October, maybe it wasn't that bad. But regardless, it was this like huge push to get people to start making these tax elections, because they're going to get an immediate benefit like 2 weeks later when they file their taxes. So this is just another thing to think about and keep under your hat in order to reduce your, your tax footprint, so to speak. So we've left some time for question and answer. So I'm assuming you guys are all building up for these questions and ready to go now. If not, we can keep talking, but I'll say, while we're waiting for the questions to come through, Peter and I have spent the last 3 years, like, really dedicating ourselves in this practice area. Our spouses are tired of hearing about it. Our friends don't care. So we welcome any question about, any of these credits. Specifically, we spent a lot of time on the employee retention credit, but we welcome questions and comments from anyone. I had a call yesterday with a CPA who was filing on behalf of a church to get the employee retention credit. We had a 20-minute conversation about, the nominal portion versus nominal effect and how it's going to work. And, he just told me he really, really appreciated our willingness to have these conversations and to have this talk with him, because he wasn't hiring us for anything. And we really, just to kind of like emphasize the point, we really do mean it. We're happy to have these conversations. We want to make sure that people are doing it right. I always say we're basically like Def Leppard in 1987, where we're never going to be as cool as we are right now. And that this is the time to ask us these questions, because it's an area of law that we've learned and it's going to go away. So this is the time to do it. All right. Josephine has asked a question. Do we pay taxes every quarterly or not for family childcare? If you have a business, then you should be making quarterly estimated tax payments. If you're not showing a profit, it might, like, that would be different. But if you're generating income, you need to be paying tax payments every quarter. If you don't, you can get penalized. I'll say a lot of small businesses don't make the quarterly estimates and they catch up at the end of the year and they pay penalties every year. And to those people, it's a better trade-off, but you're supposed to pay every quarter. If you do what Peter said, which is switch to an LLC being taxed as an S corporation, then you would pay yourself a reasonable wage. And he talked about reasonable compensation and what that means, but you'd be paying yourself on the same 941s that you pay your employees And then a lot of your tax burden is being paid through that salary. I actually have some folks that are clients of mine that used to take their whole paycheck as taxes, and then they would take distributions without kind of having to worry about making those estimated tax payments. Because I know every quarter that can be kind of a hit to do. I don't know what the penalty is off the top of my head. Do you know what the penalty is for a quarterly estimated for not paying? What the percentage is? 25?
I think it's that high. I don't know off the top of my head.
Yeah, sorry. I think it also depends on how much you owe in tax at the end of the year.
Yeah, I mean, the point is that your preparer should be working with you on estimated tax payments and whether or not, you're required to remit 100% to capture the safe harbor, 100% of the prior year, or if you're a higher income earner, 110%. So there's certain safe harbors that you're going to want to try to hit.
So Mariah just reminded me that we offer free consultations if anyone is interested in having their case scoped to see if they're eligible for the employee retention credit or any other type of credit. We're happy to take a look as a courtesy, look through your case, have a conversation with you, and make a determination of whether or not we think you're eligible. We would then typically, quote you what we think your refunds are going to be and what our fee is and all that. And then we actually defer our fee until everything is processed as a courtesy. But yes, Mariah is putting our emails in the chat. Peter also has them up on the screen. Our law firm is Frost Law, so we have a really clever askfrost.com email handle. So Ernestina said, I was told I don't have to pay quarterly as a childcare provider since I claim with my husband. So those are types of situations where you're going to have to look at your own specific tax situation and see whether or not together you make enough tax payments so that way you wouldn't have to pay quarterly. It doesn't necessarily mean because you're a childcare provider, it's whether or not your business is generating enough income to kind of reduce the amount of tax you would have to pay, if that makes sense. Josephine said, may I know what tax credit you meant a few minutes ago? So we were talking specifically about the employee retention credit. That's where we focus a lot of our practice. It's a refundable tax credit that childcare providers may be eligible for because of the certain restrictions that were, impressed upon you during the COVID-19 pandemic.
Beyond that, we talked about the work opportunity tax credit and the research and development tax credit.
Ernestine is asking if she should continue to tithe from her business. Do you want to take that one?
Yeah, I mean, I guess you can. It's going to be reported out. Businesses can give charitable giving the same way that individuals can typically.
Any other questions?
Yeah, it looks like that we don't have that many questions in the chat, but I want to say thank you guys so much for taking the time to put this out in the world. And again, this is a recorded session. So if this was just a lot for everyone to digest, and I'm sure that you guys haven't heard that, you've heard that several times before. you can always go back and once the recording is up and really spend some time, combing through it. And again, when those slides are sent out as well, you can go back and they've made themselves very readily available, which we're grateful for. So we've got one more in the chat. Barbara is asking, can the work opportunity tax credit be retroactive after hiring a qualified employee?
But check out that slide. It's very important. The dates that you do things and memorialize this stuff and work through that initial form. So devil's in the details for sure.
Okay. Well, again, thank you so much. And we'll just move on with see if Cindy has anything she'd like to say.
Hello, everyone. And I also would like to thank Rebecca and Peter for coming forth with things that, could definitely benefit providers tax-wise that they are not aware of, and for spending the time the last couple of years, as I said, trying to help with this. I can tell you I'm not an owner and I never have been. However, I have a lot of acquaintances and friends that are owners. And so I'm certainly not the expert, but I can tell you, it sounds like if you really think that there's any possibility at all to benefit from some of these tax issues, you do need to consult with someone like Frost, or maybe someone that you're already dealing with, asking the right questions to make sure that you're getting the full benefit of your tax breaks. And that was the purpose in bringing Frost, to the webinar today. Again, it's a lot of information and you will receive the slides. And I hope that somebody on this call gains from some type of great tax break based on this.
Good tax joke, Cindy.
What?
I said good tax joke.
Oh, okay. All right. Well, again, I loved your humor, Rebecca. That
Thank
was
you.
good. It was appreciated because it is a dry subject, as you know, and I'm sure that you guys have to work really hard when you're in a room full of people to, to make people laugh. It's something that sometimes makes us cry. So
It's
thank you
challenging.
again.
Thank you so much.
I also have a few minutes to just remind our participants of a few things. One, of course, is we are having our first comeback conference in person, and it will be in April of 2024, April 25th through the 27th, and it will be in Austin, Texas. And it is specifically a leadership conference for owners, directors, and administrators. And we are really looking forward to seeing many of you, at that conference and meeting many of you in person. And I think we still have some early bird discounts going on out there for participation. We also have an RFP if you'd like to present or participate. So I'm going to let Mariah, before I take it back and talk about one other thing, tell you a little bit about, where to find this information if you are interested in learning more, and we hope you are.
Thank you, Cindy. So actually, if you want to go ahead and just continue with your comments, I have several other announcements. So I want to kind of go in the flow, but I will go and find the links to those to drop in the chat while you are giving your last comments.
Okay, well, one of the things that, while I have several of you on the phone, I do want to just do a little brief overview of something really important that we're working on. We are working on a response to proposed rulemaking changes on the Child Care and Development Fund, which is the federal funding that comes through the Child Care Development Block Grant. For those of you that provide care to children that receive federal subsidies. On July 11th, the Administration for Children and Families announced a notice of proposed rulemaking to strengthen key policies in the Child Care Development Block Grant and build upon the guidance provided in the 2016 Child Care Development Fund final rule. Specifically, the rule changes that they are recommending are as follows. Cap child care copayments for working families at no more than 7% of a family's income. Mandate grants and contracts for certain populations, including infants and toddlers, children with disabilities in non-traditional hours. Encourage, because some of these things are mandates and required, some are encouraging. Encourage states to waive copayments for families at or below 150% of the federal poverty level and for families with children who have disabilities. Ensure child care providers are paid on time and based on program enrollment versus attendance, no longer to the extent practicable. And then encourage states to accept online applications for CCDB enrollment and to make siblings of children on subsidy automatically approved. So again, that's just an overview. We do have several questions for regarding some of the rules before we can, actually take a stand. For instance, when it says, encourage states to waive copayments for families, is that going to be made up, by the agency if, the provider, if the state decides to do that? Also capping childcare copayments for working families at no more than 7% of a family's income. At this point, that would only apply to people on subsidy. And again, is that going to be made up in the subsidy payments to providers? So we do have some questions that are being asked and proposed right now before we as advocates, provide a response. I am really open to hearing from any of you regarding this. I can also send you the website that you can actually provide your own response to as a provider. And Mariah always tells you how to reach me. So I'll let her do that. And at this point, that's the main thing I have to say to you all. And I hope that you're gearing up for a great school year and that everyone has gotten in a little time off this summer. Thank you for participating.
Absolutely. Thank you so much, Cindy. Appreciate it. So just want to go back and do a few things, a few announcements before we close today's session out. And I have a lot today, so bear with me. So again, thank you for being here. If you have any questions about the NCCA or about presenters, anything that you think that we could help you with, please email us. We love to hear from you about general inquiries, advocacy, membership, webinars, and any certificates. I will definitely get that information and drop it in the chat shortly. We can move on next. So speaking of membership, we have moved on to an electronic system. So BadgeCert and NCCA equals a game changer for you because we are no longer mailing certificates. They will be, once you sign up to be a member, it will be downloaded and uploaded into BadgeCert. And so you will get a full email with explaining how you can add this to your LinkedIn profile, share it to Facebook, share it to Instagram, so that people know what you're doing, what memberships you're a part of, what you've been up to, and you can go ahead and you can print it out yourself. We will no longer be mailing them, so everything is electronic at this point. If you have any questions about that, again, we did send in our email, so you can just go ahead and email us if you have any questions about how badge cert works. And speaking of, becoming a member, we are running a huge summer sale. So I know it's not technically summer, but in our minds, it is still summer because it goes until it's no longer 80 degrees all the time. So still summer to us, even though a lot of people are going back to school. If you would like to be a member of the NCCA, it is 50% off. So we have more info on that on our next slide. If you want to be a member, either individual or center memberships are 50% off at this point. So please scan that QR code. You can just take a picture of it and it should pull up for you. So secure your spot with us in this community of excellence, because being a member with the NCCA not only gives you a whole bunch of access to, advocacy and resources, but it's also just, a great community of childcare individuals who are doing amazing work, and being a member will get you a discounted ticket to our conference. But right, we are also, thank you, Storm. Just trying to follow my train of thought, which is all over the place. That we're also boasting this summer sale across all of our services. So it's total program quality. If you are someone who is looking to become, is an administrator or wants to become an administrator, we have our National Administrator Credential, or the NAC. If you are an educator, we have the Certified Childcare Professional, which is the CCP. And then if you're pursuing accreditation for the first time, you can go ahead and scan that code at the bottom, and that is going to bring you to our enrollment, which is going to be 10% off. Now, all of those, if you take advantage of this, will also give you a membership with the NCCA. So really, this is a no-brainer. If you are on this call, if you've seen us on social at all, please take advantage of it. It goes until the end of this month only, but go ahead and scan those right now. And next, about our conference, which Cindy already spoke of, it will be next year in Austin, Texas, April 25th through the 25th. So we are still working on our prospectus, which should be ready to go by in the next week or so. But we are looking for speakers, as she said. So in our next slide, we will talk about becoming a speaker for our conference. If you're passionate about this industry and you have amazing insights that you think everyone should know and you want to share with the community, please scan that QR code right there. I believe Storm is also going to drop it in the chat. Please complete and submit our RFP, because that we'll be able to see who's interested, what topics we're looking at, and if you're able to become a presenter for us, and we'd love to have you be there. So our next slide. Again, thank you for that, Storm. We want you to join us next month in September for our Champions of Mixed Delivery call. We do that every month in conjunction with our partners, the Early Care and Education Consortium. We usually have a voice from the field speaker, someone who's on the ground, who's living this in every day, and they know what's going on, what the government needs to know about federal funding, about what the struggles everyone is facing as they're going through a day-to-day process with the childcare and with families. So if you have valuable insight or you're looking to learn more about what you can do to be an advocate in your state, please join us. And I think, follow us on social. And other than that, I believe that brings us to the end of it all. So if Rebecca, if you have any last words.
I just wanted to say thank you so much. We appreciate the time. And I know tax credits is a tough thing to get super jazzed about, but we appreciate everyone's attention throughout this.
Yes, and we appreciate you so much. And again, your humor, because honestly, that made it pretty bearable.
Good to know.
Yeah.
Peter's going to die because I'm going to use this all the time. Like, everyone appreciates my humor.
God. Poor Peter. I know. And I hope that he feels better soon. We thank you both for being here.
Thanks, guys. Take care.